What can investors expect from fixed income markets in 2018? Within the context of positive economic growth, we can expect a bond market that is fairly benign. From an interest rate perspective, many see long rates drifting higher, but not meaningfully higher from current levels. Bond managers can effectively manage gradual increases in yields, but fast rising yields can create volatility, which can be much more challenging. We expect positive but slow economic growth, keeping inflation and long-term rates in check. There's also strong demand from foreign investors who see value in U.S. bonds amid low global yields. Lastly, we're seeing increased demand for yield from an aging U.S. population as many more individuals are nearing retirement. It's important to remember that while higher yields cause lower bond prices, it can actually benefit bond investors over longer time horizons as the income component becomes a larger part of total return. I like to refer to this as the self-healing nature of high-quality bonds. The other primary risk is credit risk, or the risk that a bond will default. More recently, we've seen credit spreads, or the risk premium for non-U.S. Treasuries, tighten to below historic averages, indicating a positive fundamental and technical backdrop. As such, there is not much more room for capital appreciation of these types of bonds, and spreads are more likely to widen than tighten. Wider spreads have the same impact to bond prices as higher yields. However, when spreads do widen, it can provide our active managers with opportunities to buy cheaper bonds in their portfolios. So what's the bottom line for investors in 2018? There is a potential for higher rates, but less opportunity for capital appreciation through spread tightening. High-quality bonds continue to serve as an effective diversifier to equities and serve as an important source of income for investors. Focus on long-term performance, especially if yields rise. This is ultimately beneficial for investors.